It's been a month since China devalued its currency, and the Hong Kong traded renminbi celebrated by strengthening the most in a day against the dollar since the offshore market began. Although, to be fair, there was a lot of talk of central bank support for the currency. Now, the gain leaves the renminbi just 2.8% weaker over the month. Compare that to the Brazilian real, down 2% just this morning, for a loss against the dollar of 11% over the month. And it really doesn't look like China's properly joined the currency wars. Brazil's now lost its investment-grade credit rating amid its collapse in commodity prices, capital flight and a political crisis triggered by a truly enormous corruption scandal. In a way, Brazil's a much better guide to the troubles of emerging markets than China is. Now, a mix of the same three problems face the emerging market sector as a whole. The first is falling commodity prices, and that hurts a particular group. Brazil, South Africa and Russia in particular, but also other big oil and mining reliant countries such as Malaysia and Chile. 4 of the 5 worst performing major currencies over the past month are in this group, suffering as weaker expectations of Chinese demand drive down commodity prices. There's a second group which is driven instead by the dollar. These countries have big current account deficits, so they have to attract foreign capital each year to finance their imports. This chart shows the currencies of what was once known as the Fragile Five: Brazil, India, Indonesia, South Africa and Turkey in red here, and I've added in Chile as well. All of them had big current account deficits back in 2013, leaving them painfully exposed to capital flight as the taper tantrum kicked in on the back of hopes that the US would offer higher interest rates. Against that, up here in in blue, is a group of countries which had surpluses, meaning that they send capital abroad every year. The green line is the same group, but excluding China. It doesn't make a huge difference, but there is a fairly reasonable gap in there because the measures weight each currency equally here. There's no attempt to take account of the much larger size of the Chinese economy. Now, the current account deficits countries fell a lot more in the taper tantrum back in 2013. We have, for some reason, haven't got any labels on the bottom axis, but that will be here. And this chart as a whole goes back to 2004. So I'm afraid you have to count along yourself to work out exactly where it is. But the capital flight and aversion to investing in emerging markets has intensified, and they've carried on falling much faster than this group that were the surplus countries. Now, the groups themselves have changed around a fair bit, rather like all the acronyms that were once popular among emerging market investors. Most notably, India's successfully cut its need for foreign capital and it's thriving. On the other hand, Malaysia now has seen its current account surplus fall very sharply. Now, the rupee has still dropped, but by far less than the rest of the current account deficit countries. In fact, since the start of last year, it's down only 8% against the dollar, and it's done better than the average of these surplus countries. The third problem is politics, which interacts in a particularly destructive way with the other two problems. The governments of Brazil, Turkey and Malaysia are struggling for credibility, and the very public political difficulties that they have are adding to investor concerns. Commodity troubles, current account deficits, or in the case of Brazil, both. Now, perhaps not surprisingly, Brazil, Malaysia and Turkey have seen their currencies lose the most since China's devaluation, followed by the commodity-dependent and politically fragile South African rand and Russian ruble. But this is still a long way from a full-blown emerging market crisis. One measure of the average investor's sense of fear about the countries is the implied volatility of their currencies. This red line here shows an index of the implied volatility of emerging market currencies. You can see it's up a lot from the ludicrously low levels that were reached last summer, but it's still well below where it was reached in 2010 or 2011, up here and up here, and a long, long way below the peaks that were reached after Lehman. I should just say I've got in blue here the G7, the major developed market currency volatility. That's also up a lot, but really far less than in sort of previous periods of market panic. Now, the overall market message here is that emerging markets look horrible, but they're probably not going to implode altogether. They are down a lot, and that leaves plenty of space for the worst hit to rebound a long way if sentiment were to turn sharply. But if weak Chinese demand keeps commodity prices down or political problems spread, then capital flight can create a spiral of decline. Bargain hunters in the emerging markets ought to beware.